Hello, everybody. Welcome to this webinar that is titled How Much is Your Business Worth Today? So, welcome to this session. My name is Shen Chu. It's my great honor to host our speaker, Mr. Ooi Kok Hwa, to do this session to dissect how much is your business could be worth today and what you can do to increase the value of your business. So in this session, you're going to learn three main valuation methods used by investors and buyers, and what are the value driver checklists that can be used to increase your business valuation. So today is more about the owner's guide to valuation. What are the value drivers? What are things that we need to focus on to increase our value? And how do we charter our growth so that we can sell our business at a more premium valuation? All right. So our guest today, Mr. Ooi Kok Hwa, is a licensed investment advisor and appraiser. So he will share with you his practical experience in valuing a company. So, Mr. Ooi, good evening. How are you today?
Hi. Thanks, Chen. Good evening to everyone. Good.
All right, cool. So we can't wait to learn from you about business valuation. All right, so over to you.
Okay, thanks. Thanks, Chen. Uh, Good evening. My name is Ooi Kok Hwa from MRR Consulting. So tonight, I will be with you for 1 hour, okay, to share with you on how much actually your business worth today. Okay, so today's sessions I'll explain to you that you take home roughly about 10 guides. Okay, so 10 action plan that you can actually use it to increase your company value. If let's say you intend to buy or sell business, so this one will be great for you. Okay, so before I proceed, so of course today we talk about the practical guide for to valuations, value drivers, and strategic growth your company. Okay. Now, before I start, I would like to share with you my profiles. Basically, I'm a CFA chartered holders, chartered accountants on MIA, then also a fellow of CP Australia, then certified fraud examiners, so international certified valuation specialist, and then a certified merger and acquisition advisor. So of course, my first degree is actually in natural science. Then master is actually in finance. So I'm in business appraisal for 20 over years. Okay, so I'm a licensed investment advisor by SC. Okay, I do value companies for 20 over years. So I think in the market, not many people have that kind of experience in value companies. So every year I do produce valuation report, a few valuation reports. Okay, so if you ask me, I'll say for many purposes, some actually buy, some actually sell. Okay, so I'll help them to negotiate as well, to buy ourselves. Okay, so we'll go through the today's sessions. Okay, first basically is that a lot of time actually owners actually get this wrong. Is that sometimes people say that how much actually my company values. Okay, then it says what's your profit levels. Then for example, my company is actually accounting firm. Oh, accounting firm. Then in the market, some says, oh, accounting firm 4 times, 4 times. So, or 5 times. 5 times means that if let's say your profit after tax actually 1 million, that means your company worth 5 million. Okay. Then if let's say restaurant business, restaurant business 3 times, 3 times. 3 times means that if let's say your profit after tax actually 1 million, that means your company worth 3 million. 3 times 1. Okay. So this a lot of time actually have that kind of misunderstandings. Of course, this kind of valuation is called rules of thumbs. So it's basically you actually based on in the market in US, you do have one whole book or 1 inch. Okay. Basically they have all kinds of PE for all kind of business. So the accounting firm, what are PE? The restaurant 3 times. Let's say computer trading company maybe 7 times, 6 times, 7 times. Okay, so you have one whole books. Let's say I'm a tuition center or tuition center maybe 6 times. Okay, so they actually based on certain multiples. Okay, then time your profit levels. Okay, so a lot of times actually, sometimes your accountant will mention to you this will be your company values. If you ask me, this will be a guide. I would say not wrong. Okay. You can treat it as a basic guide. But a lot of times, your company may worth much more than this. A lot of times. This is basically just a guide in the market. Sometimes actually your company do have brand name, goodwill. Then it's not fair to use this method already. Okay. So sometimes your accountant may say that, why not use book value? The book value is actually very low, no accounting value. Okay. So sometimes the owner says actually worth much more than this based on the potential growth, potential contract. So they worth more than this. So that's why you need someone actually to help you to highlight the values. Okay, so the valuation reality is that basically it's based on the cash flow, because sometimes you do have a potential cash flow, your contract, the growth is potentials. So that is actually your true values. Then sometimes certain business actually low risk, some is actually high risk, location difference. Okay, then of course you need to have documentations to show the values. Okay, to validate all these numbers, because the moment you intend to sell, then different story already. So the buyer says, I want this to see all these things. Cannot based on whatever that you think. Okay. You say your company worth this, then buyer say, no, I don't think you're actually worth that much. Okay. Market says the accounting firm 5 times only. Then you say, no, my potential is actually high. So then you have a gap between the buyer and sellers. So then that's why you need to have a proper documentation to validate all these numbers. Okay. So basically, the value and price, and actually the cash proceeds actually not the same. Okay. Before I proceed further, you will notice that I actually do have the QR code over here. Basically, today's sessions, you can see the QR code, right? You actually can use a handphone to scan it and download the whole PDF files. So give to all of you in Malaysia. Okay. A lot of times, when you buy things, you must have free gift, right? So today's all the slides actually all free for you to download it. Okay. You use it because sometimes, if you're a businessman or you are accountants or financial controller, sometimes these are points actually can enhance your company values. Okay, so I also hope that after attending this 1 hour seminars, your company actually can take one or few points here and then enhance your company values. You don't look down on some of the key points here. Okay, you can use one of the key point here and enhance your company values. Your company value may increase by 20-30% or even double up the values. So it will be great help to your company values. For example, for those actually intend to sell your business, or you intend to sell for your business 2-3 years later, also possible. So you must understand that value, price, and cash proceed not the same. Okay. So the value basically is based on theoretical values. This model, that model is actually, this discount back, what will be the values, or based on market multiples. Okay. Then the price is basically actually a buyer actually willing to offers. Okay. Then that actually depends on the market conditions, then the negotiation skills. So you sell during this time, or you sell last year, or you sell next year. So different period. Then how to negotiate the price. So that's why sometimes the buyers, after looking through your company, check through your factories, hey, this discount here, discount there. Then so they look at the conditions. So there's actually the actual price offer. Okay, then cash proceed basically is that this is actually after minus up all your tax, the debts, the repayment, everything. So that's why this actually the cash proceeds is actually the take home. So you minus out, because your loan basically is actually your company loans actually the guarantee is actually by you, okay, the personal guarantees or the loans. So that's why when you take all this money, it's actually minus out the loans. Okay, so this is actually the cash proceeds. So you must understand the values and the price and the cash proceeds actually not the same. Okay, especially the price is actually when the buyer look at your factory, they walk in the factory, they say, hey, this no. So is it inclusive this, exclude this? Then they check your conditions, no. So the due diligence of the companies, so they discover different things. So plus here, minus here, then a lot of times the numbers may not be the same like the book values, okay? The actual situations, okay? So the buyer also know, okay? Then, so what is actually valuation? Valuation is actually this a combination between art and science. A lot of time people says, so is this science? No, not purely science. So is it purely arts? Is this guessing game? No. We have a systematic to derive the values. Yes. Okay. But the range of the value actually do have a certain range. Okay. Certain business actually, if you ask me, over 20 over years, the value in basically in conclusions of the value actually derived from three areas only: income, market, and assets. Income means how much your income they can generate in futures. Market means how much market they are paying right now. The PE is actually one of the simple methods. Asset is actually how much your asset worth, your properties, plant, okay, your machines need to be revalued. No? So that's why it's basically come from these three only. Okay, so key points basically is that they do talk to each others. So that's why the values, why the gap in between, because of these three, and they have certain range one. Okay, you cannot say your discounted cash flow is actually not true. It depends on what type of rate that you use, what type of discount rate that you use. Yes, different growth rate, different discount rates actually have a big impact of your company value. No doubt that. Okay, but do have a certain range. Okay, sometimes the value that you computed actually not make sense. Okay, not make sense means not make sense. Okay, so because examples okay, I value one companies one printing companies during pandemic time. Okay, so the financial controller they actually forecast for the next 5 years. They provide me the Excel files. Then they actually have a forecast for the next 5 years. Every year grow by 20%. Because that printing company actually benefit from the pandemic while doing packagings for the vaccine bottle, all this. Wow, very good. Then I think my value is actually 2021, 22. I only use for 2-3 years only, even though the financial control provided a forecast for 5 years. I only use 3 years only. Then you may ask why. I say by that time, the pandemic will be over already. So to me, it's actually not make sense. If I use 5 years, the growth rate every year grow by 20%, the company will be worth a lot of money. But I'll use 3 years only. I say that pandemics, if you look at the Spanish flu, only 3 years only. So at that time, that's already 1 or 2 years already. So I say that maximum another 2 years only. 2-3 years. 3 years were the maximums. So instead of use 5 years, forecast, I use only 2-3 years, only 3 years only. So that's why then after that, because printing business, if you look at historically, the growth rate actually not very good. Okay, about 5% only. So that's why key point basically is that different growth rate have a big impact. Your high growth periods, when how many years? So these are all assumptions. Then we are the one to make sure is it make sense or not make sense, because sometimes business owner actually don't know. The financial control, they thought whatever that they have right now will continue, but sometimes may not be. Then the discount rate that you use have a big impact. So they have a certain range of the discount rates. Different rate imply different business. So actually we do have the rate that you use do imply what our business, the business risk. Okay, it cannot be just you plug from the air, this 10% discount rates or 20% discount rate. No. There are certain business, every business that do have a certain range of the rates, okay, of the returns. Okay. Then the multiples, like for example, use the printing companies. Actually, I come up with 9 companies. Then I ask the sellers, I say that, so these are the 9 companies. So which one is actually really similar to your business? In the end, he picked only 3 only. He said the rest actually not the same. Okay. So yes, printing packagings, but the rest actually not the same. So ultimately I use how many? And these are all 9 company listed companies. So in the end, I use 3 only, because the owner says, the seller says, these are three are related to me, my competitors, but the rest actually, you may say it's actually same, but actually not the same. So if I say I use all of them, then some may be very high, some may be very low, don't have a big variance in the values. No? So you must check with the sellers, especially the business owner, what will be really your close competitors. That's why when we value companies, we do have a questionnaire sent out to them that I think it's about 17 pages. I think questions will be roughly about coming to 100 questions. The seller need to fill in, especially the financial controller need to fill in a lot of information. That's why sometimes the seller says, wow, I need to fill in so many information. I said, never mind, try your best. More details actually you provide to me, then the valuation report actually will have more details of companies. Don't worry. Then including the pictures, I'll take pictures and but with your permissions, you allow all these pictures and put into your valuation reports. Because sometimes you want to sell companies. So the buyer says, no, I have this, I feel that your company worth this. Then you say, no, my company worth this. So there's actually a gap. So that's why this is where we come in to help you. Okay. So next one, value is not guess. Okay. So look at your cash flows. I value one company, okay, startup companies, 3 years startups. So book value is actually about 2-3 millions. I value the companies that I think ultimately is actually 80 millions. 80 millions. So because the potential cash flow is huge, okay, because I can see the growth rates, then that's why the most important is actually the potential growth. Okay, so and they actually can see the growth. Okay, even though it's startup companies. So and when they launch the products, certain they actually sign contract with all these listed companies with the government. So that's why you ask me that kind of business actually have that kind of values. I'll say yes, and I can access to all the company documents. You can see all the inside information, the contract signed with the customer, contract signed with the supplier, all the government contract. I can read through all the contract because I can. That's why our job basically do some partial due diligence of your business. Okay, then basically it's highlight the risk involved in. Not only look at the potential, then also look at the risk involved. Okay. So the sustainables, more predictable of your cash flows, then of course your value will be higher. Let's say recurring revenues, that will be even better. Okay, so definitely worth more than actually one time that kind of project incomes. Okay, then that's why you need to have a proof documented. Okay, that's why all these cash flow projections is actually supplied by the sellers, financial controllers. You provide me, then my role is to verify your information. Don't expect me to do forecast for you because I don't know your business. So my job is basically look through the forecast made by you, then I verify it. Or okay, then I'll ask you questions. Hey, this don't make sense. Or then I want to see the growth. Okay, then you say your business come from this segment. So the customer come from where? Okay, from northern regions, central regions, or Sabah, Sarawak, or who are your customer? How much each person pay for one? Then it says your growth will be next year will be this. Then per month actually how much you are selling? One customers are paying how much? So I need to look through. Then I look through, make sense. Can get this out. That's why I need to verify in the market as well. It makes sense or not? Your things actually. Then second part basically is that if you are sellers, the buyer may want you to provide the profit guarantees. Don't simply forecast. Okay. You must understand the seller the buyer may want the seller to give profit guarantees. Okay. So meaning to say is that you may not able to get all the cash proceed. Okay. So they may tie you up for 2 years, 3 years, 5 years. I'm not too sure. Okay. Depends on you already. So that's why you ask me all these forecasts reliable or not. I would say quite reliable because you need to be responsible for the forecast, okay? Because ultimately, the buyer says you unable to deliver this type of profit or sales, then you may not get this type of proceed. So that's why before you come out with the whatever forecast, you need to think twice. Okay, that's why you ask me, reliable or not? I would say quite close, quite close. I will not say because things change every day. We may not know futures, okay, but we try our best. Okay, but the main value still come from the future cash flows. Okay, then that's why I mentioned to you the growth rates. Is it make sense 5-year growth rates or 3 years growth rate, like kind of high growth periods for how long? Okay, then your recurring revenue. That's why I mentioned to you repeated customers. You look at certain consumer-based business, repeated customers, the value will be higher. Okay, one-off things, the value lower. Depends on whether you can get contracts or not. A lot of construction companies, that depends on government contracts. Sometimes they may not able to get contracts. Then, so sometimes you notice that, and the PE they're selling will be lower as compared to certain consumer base, because they got repeated customers. So and they're huge customer base. Then actually, the value will be higher. Okay, so some customers, you notice that, like some listed companies, they only have certain limited customers only. Then that's why you see the value actually lower. Okay, because customer concentration, the best will be more customer base. Okay, if possible, if let's say lose out certain customers, it's okay because they a lot of customers. Then the risk actually lower. The value of company will be higher. Okay, then check through no clean books, no audited financials, reduce the risk. What are the hidden value killers? Margin pressures, declining gross margins. Nowadays, actually not easy to do business. So that's why competitiveness, margin coming down. Okay, buyer may penalize your business. Okay, then sometimes your working capitals, okay, tie out. Sometimes your inventory cannot go. I mean, your inventory gets stuck. Okay, so need to check through. Okay, that's why we need to ask. Look through. I'll look through your companies. Okay, and ask you, and then let me go to your companies and look through check through the numbers. Okay, so sometimes actually certain inventory actually get stuck. Okay, just I mentioned to you on the key person risk. Okay, if let's say one man show your company is because a lot of time the key company owners actually the most hardworking because actually you're the owners. So if let's say the whole company depend on you only, then your company value will be lower. Why? Because the moment you sell, then the customer engage is because engage you only. Okay, so the best is actually you must actually have a team that can handle your business. So if you have, of course, then we have a team, then of course your profit margin will lower already. So a lot of times profit margin higher because actually one man shows because they don't charge salary, everything's the owners only. So but if you want a company with higher, the best will be have a management team. So even though you're not around, then the business actually still can continue. So then the key person risk actually will be lower. Okay. Then governance gaps. Okay. You have no financial controls. Check through all your numbers. More formals, documented all the things. Okay. So more structures, more systems. Then your value will be higher. Okay. So then hidden liabilities. Look through any litigations or not. Any pendings. You sue customers or customers sue you. These are all. That's why sometimes the moment you see, why you do have a pay money to lawyer that we do due diligence, not a good sign. Either you pay money to lawyer, whether you sue people or being sued, also will affect your company values already. So look through there any environmental issues or not, or charged by the Kementerian, those persekitaran or not. Okay, all these all the environmental issues, then actually will affect the company values. So these are the 5 margin pressures, working capital drain, key person risk, governance gaps, hidden liabilities. Does I mention to you that the approach, basically, you have these three approach, okay? Income means that basically discount future cash flow to present values, okay? If you actually value control shares, then we use free cash flow to free cash flow methods, either free cash flow to equity or free cash flow to firm. So this actually control shares. If you value minority shares, so then use the dividend discount models. This is income methods, okay? Then under market approach, so this market approach will be like PE. The value of company depend on market price, okay? Depend on market price. So if let's say cyclical business, like property companies, plantation companies, stockbroking firms, then market approach actually will carry higher values because the value of company depends on market price, okay? Then how much is it selling in the markets? Another method is actually fall under this will be the what type of business is actually selling in the markets. Okay, like just I mentioned to you, like just on the rules of thumbs, this is actually the markets. There's certain type of business actually belong to the category. This is PE, how much? Like for example, just I mentioned the restaurant business PE of 3. Then this maybe 4 or 5. Trading companies maybe 6, 7. This actually, these are all market. That means depends on the PE multiples. Okay. Next one is actually asset approach. Asset approach means the value of company depends on the asset that you own. Okay. So that's why when I value companies, I mentioned to the sellers, you need to get because I'm only value business. I do not value your property and plant. Okay. So you need to engage the property valuer to value your properties. Now I'm not good in it. Not good in actually value properties. Okay. So you need to engage the property valuer to value properties. Then machine, you need to engage the machine valuer to value the machines. Okay. So we do have that kind of valuer to value your machines. Then you combine together all this, that will be your asset approach. That means it's a market value of all your asset minus market value of your liabilities. That is net asset approach. Fall under asset approach. Okay. So basically, the value company come from 3: income, market, and assets. Okay, that's only. Okay, of course, when we value company, we'll value based on these 3. Then, of course, under this approach, we do select a method that can reflect your companies. Market approach also the same. Then asset approach also the same. Find one method actually can value companies. Okay, then we use the weighted, then come out what will be the final values. Okay. So now we talk about the discounted cash flow. So remember, it's actually discount future cash flow. So that's why the sellers, the financial controller need to provide the forecast. You need to come out. Okay, more details better. That means your sales, the next year's sales come from where? Okay, monthly, give forecast. Then from which locations, sell how many units, each one how much, so that I can verify the information. Then check through your capex, all this, so to calculate your cash flows. Okay, free cash flow. If you don't know how to calculate the free cash flow, it doesn't matter. You provide your forecast, then I know how to do adjustment to get the values. Okay, the key point basically is that I will ask you questions on all your cash flow forecasts. Remember, I mentioned just now already, the buyer may ask you to give profit guarantees, or you say, or you can generate this cash flow, that cash flows, or for this 1 year, 2 years, 3 years, they may tie you up for that periods. So make sure you can deliver that sales levels and the profit levels. Think twice before you come out with a forecast. That's why sometimes certain business owners, they actually don't understand. They say, "Ayo, I want to make my company value worth more, then I'll forecast high cash flow." Then, sorry, the buyer may actually want you to deliver whatever they forecast. So you make sure you're able to deliver. So then your cash proceed may tie you up. Let's say they say that, well, you can grow like this every year, 20% or 30%. Then they say that, and then you deliver for us for 3 years. Then you cannot get all until you deliver your whatever they stated in the cash flows. So take note of that. Okay, and that will be the terminal values. I mean, let's say 3 years, right? Like I mentioned to you, the printing companies, 3 years. I mean, instead of 5 years. So because the terminal values, will actually, comprise actually, 60, 70, 80% of the total value already. That's why you whether use 3 years or 5 years. So I value one UK company before. Okay. So they actually provide 5 years. I actually use 3 years only. Then the buyer says, why not use 5 years? I says that I don't think you can tie up the seller for 5 years. 3 years makes sense because 3 years actually the sales go back to the pandemic levels. 5 years, I'm not too sure because the sales actually, the forecast by the sellers is already beyond the pandemic level already. I say, I'm not too sure whether they can achieve that or not. First point. Second point is that you want to tie up the seller for 5 years. I'm not too sure. No. They say, why not tie down 5 years? I say, difficult. I think 2, 3 years max to maximum already. 5 years. You want the seller to do to work for you for 5 years. I myself don't sell to you. I don't think who want to sell to you that kind of business. So I don't think so. So that's why I use only 3 years. But if I use 5 years, the company value will be worth much more than this. Though then of course need to discount the present values. Okay. So this is actually the discount cash flows. Then next one is actually valuation multiples. So I helped one company before. So they're startup companies. Okay. Start from zero. He's actually my CFA students. So I helped him. So loss making. Say, so Mr. Ooi, so what's actually my company values? I says, how much your sales? He actually start to sell things online. I say, well, can sell these are things actually can sell online. Yeah. Then he actually deliver. Then key point basically is that he actually loss making. Okay. Then for 4 years, then actually the sales actually went up to 500,000 per year. I say, they say, Mr. Ooi, so what's my company value? Your internet business, right? So I say 500,000. 5,000. So basically, 5,000 means use the revenues. That means one time of the sales, one time of turnovers. This is revenue multiples. You use for a lot of these startup companies, for these no loss-making companies. You look at the Nvidia, all these, they say how many times of their sales levels. So you ask me one time about there. Okay. So I attend some of the all these in the market that you do have all these the startup company valuations. There are a lot of time actually they use the revenue multiples. Then of course sometimes they actually tuition center, how they value it? They value actually based on the how many students you have, then how much each student pay, then for 1 year how much you can get, then they calculate by your students. Basically, ultimately it's actually the revenue multiples. Okay, 1 time, 2 time, 3 time, whatever. Okay, will depend on how recurring or how stable the revenues are. Next one, especially for SME, small companies, a lot of time the best one is actually EV over EBITDA. Okay, the EBITDA multiples. Okay, if you look at in the markets, a lot of times EV stand for enterprise values. That will be the main one. Okay, for valuing the small business. Okay, Sandian Berhad or the private limited companies. These are EBITDA multiples. Okay, so we use it. Okay, to values. So how many in US they do publish all these EV EBITDA multiples for all kind of industry, and then they publish it quarterly. You can use it as a guide. Okay, so this actually is the best for those SME business, small medium business. For big company, then of course using PE, listed company, large company, public companies use PE, these earning multiples. So sometimes you may be you're not profitable, then you look at price to books, financial institutions, then price to books. Then sometimes you loss making, then price to sales. These are also fall under the valuation multiples. I mean, the value company depends on the similar business in the markets. Okay, how many times? Then why using the multiples can actually mislead you, because sometimes that's why I mentioned to you the sound. Sometimes they may not be the same. Okay, so the condition may not be the same. Okay, so sometimes you are selling at the bad time, then the PE very low. So sometimes actually your cash flow actually solid. So your company may not be actually the same as whatever they use in the markets. So I actually value one business company before. So the buyer is actually a listed company. They actually says that the other business listed companies with that kind of business, they say the PE that kind of low PE. So, but the seller says they have a brand name, and they actually they want these out values. So they're actually much higher than whatever the market multiples. So of course, in the end, cannot go through. Because to them, actually, they have brand names, and then they are already in the business for 70 years. So they want someone pay for the brand name, and they are family business. So you ask me, I think it's quite okay. The business is quite okay. Just that you do have others when they want to sell at that time. You do have other listed company. Actually, the PE is quite low, so quite similar business. Then of course cannot go through. But the seller actually insists that they want that kind of value. So of course, the market don't want to pay for that. Okay, and the sellers insist that, and the business actually have potential growth, doing franchising, all this. Then of course cannot go through. Okay. Then picking the highest multiples, okay, without realizing that they had a 50% growth. Well, actually have only 5% growth, say, ignoring the context. Then adjustments, size factors, liquidities, discounts. So because sometimes may not be exactly the same. So we are selling a control stake or selling a minority stake, also different. You need to do adjustment. Selling a listed company and selling a private limited company, that means certain private companies, it's actually not the same. You need to do liquidity adjustments. So control as well. Whether you sell more than 50% or selling below 50%, also difference. You need to adjust the control, lack of control discounts or lack of marketability discounts. So these are all the discount need to apply. That's why cannot be just multiple like this. Whatever PE that you see in the listed company, these are all minority values. Though. If today you want to control the listed companies, the PE is actually not what you see in the over there. You need to add in control premiums. So these a lot of things they are not taken into pictures. Okay, because whatever that you see in the PE, because a lot of times the buyer says, that is actually the market multiples. Okay, but you must understand the PE that you see in the market, the listed PE, is actually minorities. But today you want to take over the whole companies. And you need to add in control premiums. Because you control 100% of the companies. Different story. So that's why sometimes people don't understand this. Okay. Last one is actually the asset-based valuations. So this is actually the just mentioned, the market value of all the assets minus market value of liabilities. So your property need to be engage the property value to value all your properties. Then your machine need to revalue. Then liability a lot of times is actually book values. So, but remember, they actually do not take into consideration of if you have IP patents, IPs, goodwills, this one not take into consideration. So that's why asset-based valuation is just a guide only. Do not take into consideration of the goodwills that you have, the patents that you have. So that's why you ask me, can value or not? Can be values. Okay, can be values. Your goodwill as well. Okay, your brand name as well. Now, today's sections, take home, actually the 10 factors the buyer can examine first. Basically, these are the 10 factors. And these 10 factors actually do have an action plan for you. Okay, I'll share with you right now. Okay, we look through one by one. Okay, these are 10 factors. You use it, enhance your company values, it's good for you. Okay, first one, earning qualities. So check through, no? Okay, so if possible, check through 100%, no, the recurring revenues. Okay, so not one off. Okay, that's why document all recurring contracts and calculate how many percent actually your recurring revenue. So If I say high percentage recurring, then your value will be higher. This is actually first point. Okay. Then second point basically is customer concentrations. Okay. Instead of depends on a few customers, you diversify to many customers. Then your risk will be lower. You do not depends on few customers. Then your company value will be higher. So this is actually the second point. Each point do have an action plan for you. Third one is actually the pricing powers. Okay, so whether can actually your company can actually raise prices without losing customers or not. Then that's whether you actually can increase price on the low risk segments or not, or with the new customers. Then if you do a pricing powers, then your company value will be higher. Okay, this is actually the first 3 points. Okay, next one altogether 10 margin structures. Okay, so check through whether the actually is pricing power and cost control. Okay, so this operating margin actually indicate the efficiencies. So if let's say your actually margin coming down, this actually is a red flag for you. Then of course you want to sell it, then wow. So if your margin already coming down over years, so declining trend, then of course your value will be lower. If possible, maintain or increase the margins. So then you need to identify what are the low margins offering, then or to fix or cut or whatever. Okay, then check through your margin trends. Okay, this is the fourth point. Our fifth point basically is the working capitals. So the money actually tie up in the business. So inventory, receivables. Then buyer actually prefers actually with the efficient cycles. Okay, I mean not much money actually tie up in the inventories, receivables. So then that's why your financial control part can actually implement tighten collection policies or optimize your inventory levels. So this actually will enhance your company values. So lower down the money actually tie up in the your debts or tie up actually with the inventories. Number 6, just now also mentioned already, the don't depends on one person. So diversify, if possible, then you have a second in command. Okay, so that you're not around, your company still okay. Then of course to engage someone to high position, of course salary also higher, the cost actually higher, then profit margin will be lower. So you notice that a lot of time profit margin lower, company bigger size, a lot of times you may say, wow, my profit margin will be affected, all this, but you notice that the company value become higher. So easy to sell this out business. Do not depend on key owners, because it depends on key owners. Then if let's say owner want to sell, then the customer, because for example, lawyer firms, a lot of time actually the customers actually follow the lawyer. So the moment change your ownership, then they say, oh no, I follow that lawyer. The lawyer actually change your ownership already, then I don't want already. Then sales will be lower. Okay, that's why sometimes actually you will have a team, then lower down the key person risk. Okay, value will be higher for your companies. Next one is basically on the governance and the documentations. Okay, so that's why if possible, use the accrue based actually reporting rather than cash based reportings. Okay, then so that this actually not proper. So these are all the moment you intend to sell. So this will be proper because actually you use accrue based actually reportings already. Okay, so that's why you need times so to prepare a company the moment actually you intend to sell rather than based on the cash base. Okay, then number 8 will be documentations. So if possible, have a proper documentations. A lot of times actually once you have proper documentations, then you create a digital data set rooms so that everything will be more proper. Okay, employee handbooks, all these operation, all these contracts are so easy for people like us when value companies, all the documentation very important. So if you intend to sell the business, then of course you start to have a proper documentations, then so easier for us when do some partial due diligence of companies. Okay, because we need to check truths. Okay, buyer side also the same. So you start preparing for companies. Okay, so if you're not written down, that's why it doesn't exist. Okay. Then number 9, 10 basically is that look at any the debts, okay, uh, high debts actually reduce the cash available to the owners. So that's why you need to lower down your debts, okay, review all the debt covenants, okay, ensure that you're in compliance, to play down actually the high interest obligations. So a lot of time the buyer actually want the business actually the manageable debt levels, clean balance sheets. Then the final 10 points, the last one will be the check through no hidden liabilities, make sure no litigations, environment issues, regulatory violations, all these are deal killers. Okay, so check through, make sure complying with the government's rulings, environments, proper checks. So no have a litigation. Try to solve all these, whether you sue people or people getting sued, all this, try to minimize it or remove all this. If let's say you intend to sell, okay, that's why we do check through all this. So check through, so that's why the moment you actually intend to sell, so remember all these 10 points. So remember, you do notice that your QR codes, you can scan these QR codes and download these PDF files. Okay, then if you can use a few of these key points and enhance your company values, it's good for you. So today's sessions actually will really enhance your company values. It's actually good for you. Okay, so your path forward basically assess. So this one is actually the value drivers scorecard. Okay, be honest to your weakness. So try to identify your weakness. Every company actually not the same, different industry. So try to what's your strength, what your weakness. So try to solve all your weakness. If let's say you intend to sell, or not, you may not intend to sell, but you're actually planning it 3-5 years later. So today's session, you use all these points. You can use any of these points, enhance it, and lower down your weaknesses. Okay, then enhance actually your strength. Then your company will be higher values. Really congrats for you are able to get it, and later on you enhance the company value. It's really good for you. Okay, then if let's say gathers all the informations that have a data rooms. So if let's say you start to preparing your companies, then if you want people like us to help you, we actually can schedule valuation readiness assessments. We can actually help you on the normalize actually your earnings, actually identify your true market range. This actually you can people engage us. Okay, so if you ask me what one valuation report, I'll say our fees will be 30 plus, 35K, 35K to 40 plus, 40 OKs for one valuation reports. Then if you ask us, because if you ask all the big four to value for you, more than 100Ks. Okay, so if I say overseas, then we need to add in the transportation accommodations. Then second part basically is that take how long to prepare it? I would say it's roughly 2 months. A lot of time, why 2 months? Because the gap is because of the delay is because of your financial controller. Because it takes time to prepare. First is actually you need to answer. I have 16, 17 pages of the questionnaire, so you need to fill it in. So first part. Second part basically is that you need to give me your projection, cash flow projection for the next 3 years, 5 years. It takes times. Okay, a lot of time the delay is actually because of this. Sometimes if it's a Mr. Ooi, so many questions. Yes, more you provide us more detail, then your valuation report will be more details of your companies. Then will be good for the buyers. Okay, you highlight the company values. Then second part is actually you need to make sure whatever forecast you can deliver. Don't simply forecast. So make sure talk to your finance managers, financial controller. Make sure that whatever cash flow forecast you can deliver all those forecasts. So because we need to verify it. Okay, that's why sometimes you take times because of delay, because of this. Okay, then upon getting all this information, we still need roughly 2 months to come out, because we need to inspect your factory, come to the company and check your company. So where is it located? Really inspect it. That's why in one valuation, sometimes people say desktop valuation cannot. If let's say you're selling control state, you need to have if let's say the valuation report come out, whoever come out with valuation report without the site visit in our business appraisal, is actually not valid. Need to have a site visit. So you walk through the factory, walk through the company, then you know, where is it located? Seems like the one you in UK. Then you know, very far out from UK. Wow. So I really check through all the documents, all the details of the companies. We do partial due diligence. So that's why it all take time. Not full due diligence, we do partial due diligence. So you ask me roughly two months. So that's why then it's not like your company profit this level, then your PE is how many times. This is just rough estimations. I will not say wrong. You ask me, this is a range, but if your company worth much more than this, so you feel have more, you really feel that your company worth more than that, then different stories. Okay, need to have a proper way to value companies. Okay. Then you actually can contact us. No, this is another QR code. This actually straight away go to the website. Okay, so you can actually access us through this QR code straight away. Our MRR Consulting actually websites. Okay, so I'll share with you our website right now. Okay, we do have courses for those actually want to enhance knowledge. No? Okay, so. So you actually can go to our website, okay? This is actually our website, okay? Then we also do have online courses, okay? For those actually want to learn on the business of valuation methods. So we do have 4 hours courses. This actually will more in depth on the valuation methods and applications, okay? Per pack is actually 350 per pack. 3% and above, actually we give 30% discounts. Then we also have someone actually, if let's say how to know how analysts pick stocks. So we also share with you this course on the 14th. The some business appraisal, business valuation methods and application is actually 28 February. Then on how analysts pick stocks, actually on the 14th of March. Then on the valuation of merger acquisition, I will use the listed companies examples that in Bursa, Malaysia, then use that share with you on how to value and merger and acquisitions for listed companies. Okay, these are on the 28th. All 4 hours cost, okay, 300 per pax. Okay, if let's say, you say, Mr. Ooi, I want to, these 3 can get 30% discount. You enroll three of us can. We also give you 30% discount if let's say you enroll 3. Okay, so basically, this is actually our website. Okay, so in case you need to contact us, actually you actually can type your names, phones, email, then your message actually over here. Okay, website. Then you submit to us. Then we actually will contact you. Okay, so or you send us emails or phone numbers available. Okay. So this is actually our website. So the sound I'll share with you the QR code. Actually, you'll straight away come to this website. Okay. So things that's all. Okay, from me. Okay, now pass back to Chen for Q&A sessions. Any questions?
All right, thank you so much, Mr. Ooi, for sharing with us about the essentials of business valuation and how do we enhance the value of our business. So if you have any questions to ask our speaker, Mr. Ooi, you may write them at the Q&A box, okay? So today session is very exclusive for entrepreneurs, business owners, or people who aim to become a business owners yourself, okay? So I hope that you have walked away with some of the tips on what you can do to enhance your business value. So the first question I see on my screen is from Ronald. So are there any platforms that tracks all the buy and sell companies or list company who want to be sold, or so you know which company you can acquire?
I think our our government actually do buy one database. Okay, I can't remember the name really. I think they do keep track. Okay, so they actually keep track of some of the prior transactions. But I noticed that actually not many multiples. Okay. But because of they actually, they actually do capture over there. So as a result, that database actually give you the private companies actually the range. I think the company name is actually Valutico. I think yeah, I think it's a Valutico, these companies. So they do have a database for Malaysia, but this company is actually not uh, just Malaysia only. They have a database for many countries. So the company name is Valutico. I noticed that I think our government actually do subscribe to this. Okay, so you actually can use that. Okay, uh, if let's say normal person whether can access to that, I'm not too sure. But actually, they do have a range for different industry, the PE range. Okay, based on some actual historical transactions. Okay, how accurate I'm not too sure because sometimes I look at the range for this vertical, the range sometimes actually not make sense. Wow, 20 times that high for computer companies, software company. So I'm not too sure whether true or not true. I'm not too sure. But I look through, they give a range, but they don't have they give only PE range, but not the actual transactions. I don't have just a PE range only. Any other
Mm,
questions?
okay.
Anyone?
Any other questions?
I don't have.
So what kind of discount would you give to a company with like a very few owners, like let's say two owners?
Uh, key person key person risk.
Mm,
I would say I mean uh, need to actually add in the risk into the discount rates already. Okay. For if let's say they do have the owner risk, then need to add in into the discount rates already. Okay. We'll check through what actually I would say if let's say really keepers the whole company depends on key persons, then the rate may be I would say 3%, 3% or 5%. Just add on to that. It depends on the
you
how
mean five
serious the
percent
things.
discount lah? 3 to 5%.
Additional
A
on
risk
top of
or
additional
additional risk.
additional risk on top of your risk free rates and equity risk premiums. These are specific company risks on top of that. These key
Mm,
person risks actually this additional risk. Okay, three to
mm,
five percent.
okay, I see. Okay, so any other questions from our audience today?
Yes. Any other questions?
Okay, of course, if you need Mr.
Oh,
Oi's service, you can always go to his website, reach out to his team to see if you
oh,
can, if you need to get
I
his
think
team to
there's one
do
question.
appraisal.
I think Philip Kong, right?
Yeah, Philip Kong, okay, ask, how do you value a dental services clinic without
Without
any
any branch.
branch?
So that's why need to check through your your cash flows. Okay. So of course the clinic, if let's say no dental clinics, right? So I know last time I have a client, it's actually they're actually doing very big. They actually have a lot of branches. So then you notice that actually there are many dentists actually over there. So the risk actually lower. If let's say your dental service is actually key persons, then the risk actually higher already. So because the customer actually look for you is because of your skills, then your professionals. So then the key person risk actually will be the main one. Okay. So we need to check through. Not so much on your one whether your one branch is actually how many dentists you have. Okay. So whether is it depend on one dentist or you have a group of dentists? Then as mentioned to you just now, last time I had one client actually they own the dentist actually doing very well. A few, I think one or two branches. Many dentists inside the company actually very big. So that's why then the value will be higher because actually not depends on one dentist.
Mm, all right. So the next question is by Hangry. So if Sunway acquiring IJM, which is now recently in the spotlight, is the valuation good for minority shareholders?
I think you can read through from the valuations analyst report. Okay, I think it's the view actually is actually okay based on my understandings. Okay, I actually rough calculation. I mean rough. The whole deal basically is depends on the Sunway. I think 50% about 500 shares actually from Sunway. 50% come from Sunway. So meaning to say the Sunway up and down actually do have what impact on IGMs. So then they give you 30 cents. So that means the 50%, the 500 shares are from the Sunway side. So of course they put at 565, the 500 shares actually worth $2.80, then plus 30 cents, then worth $3.10, 315. So ultimately it actually depends on Sunway. So my point basically is that what if let's say Sunway price actually drop? And if you look through the charts actually, the Sunway price actually went up from the $4 plus all the way to 5.560s. So what if let's say the price go back to $4? Wow. Then your $4, actually 50 cent, 500 shares. That means it's actually $2 only, Then plus 30 cents actually four two 30 only. So then you decide, not I decide. So is it good for you? No? Then you look at the one, I think a few research report, they say that they actually value the IGM shares as $3 plus. So I would say it depends on independent advisors, the reports, okay, by the company engaged. So what will be the fair values? So if you based on the analyst view, they actually publish it. So I think they value IGM actually worth more than that.
All right. So thanks, Mr. Ooi, for your 2 cents of opinion about
This
this
rough,
deal.
rough, rough. Yes.
Uh, okay. I think the follow-up question is, will you buy Sunway or not? Or will you buy IGM or not? So I'm not sure if you like to
I think
take
you
this
wait for a
question.
while.
Okay.
Wait for a while. See what happens.
So the next question by Ronald is, any specially help to look for value buy business or help to sell business, like a business hunter? Are there these specialists?
In US, they do have the one professional titles called the CBI, Certified Business Intermediaries. I think we don't have in Malaysia. Okay, in US they do have. And that type professional titles, it's called the CBI. It's called Certified Business Certified Business
Intermediaries.
Intermediaries. Basically, is that they try to tie up the buyer and sellers, then they actually earn the commission in between. So you ask me, Malaysia do have that or not? I don't think so.
Mm.
So, but you can check through some accounting firms, or big one. Sometimes they do come across some business to buy or some business to sell. So because I'm actually members of the BVAM, Malaysia Business Valuations Association of Malaysia, one of member over there. So sometimes we ask occasionally, if let's say have a meetings, then we share out certain business. But actually, we don't have a proper platform for the intermediaries, for the whoever want to sell the business or whoever want to buy the business. Okay, we don't have that.
Mm.
I'm a certified M&A advisors. So I do have they do have. Then I don't want to subscribe to get all this because they actually uh, they give in US the different location to look for buyer and sellers, and they actually very specific on what type of industry, the SIC code, what type of business, because you talk retail business that they have a very specific SIC code and which location in LA, in Florida, in Chicago, they are all different. So they have a very specific buyers and looking for buyers. So also have a specific look for sellers as well. So they have a huge database that every day, a lot of deals coming in. Occasionally, you can come across the European deals, Asian deals, totally none. So only Americans. So they are more advanced than us.
Mm.
Malaysia government should come up with a platform for the business to buy and sell. Which one is? But we're too small.
All right. So it looks like we have addressed all the questions in our panel. So it's just about time that we end this session. So thank you so much, Mr. Ooi, for sharing with us. How much is your business worth today, which is a practical owner guide for us to take out with some of the key ideas that you shared later just now, so we can enhance our business value itself for premium valuation lah. Okay, so with that, thank you so much, Mr. Ooi, and hope that you guys have walk away with key inputs today on how you can enhance your business. Bye bye, everybody.
Okay, thank you. Thank you. Remember the PDF apps. Okay, it's here
Okay,
as the guide. Okay, enhance our company values. Okay, thanks for your support. Thanks.
thanks for the gift.
Thanks. Thanks.
All right, bye bye.